what are the best stocks? What are the type of stocks that will perform very well over this next bit of time, being that we're at inning one of a new cut cycle, right? And then we'll talk about some hedging and some of those sorts of things. Well, the automatic, everybody should know this, is small caps. If you're in a cut cycle, generally speaking, good for small caps, right? Lower interest rates, good thing for small caps. And so naturally, we should see continued momentum, being that we're at the beginning of a cut cycle in small caps. With that being said, keep this in mind. When you get those drama time periods, economic worries, small caps are going to get hammered in the short term. So if all of a sudden you get a 3-week period where the market's freaking out, worried about this, the economy is actually going to go through a crash, the Russell's going to get wrecked. So just understand, the Russell might be a great play over the next year or the next couple years, but it could go through some periods where if all of a sudden the market starts freaking out about we're going into a recession, like a real big recession, right? You could get the Russell to sell off 15% in a week. So keep that in mind. But the play should be, in theory, as long as you don't get anything dramatic, small cap should be the play, right? Now, additionally, I did a video called 2 stocks I will buy nonstop the next 90 days. 2 stocks I'll buy nonstop next 90 days, right? Those 2 stocks are set up perfect for the next 1 to 2 years. Those stocks are set up for the next 5 to 10 years, in my opinion, but they're really set up phenomenal for the next 1 to 2 years. When you watch that video on those 2 stocks, right, it doesn't matter if the Fed's in a cutting cycle and it doesn't matter if the Fed cuts 50 more basis points or 100 more basis points, like those 2 stocks are going to do well, no matter what. If there's economic worries, those 2 stocks are going to be the type of stocks that people want to flood to. And if there's excitement around the economy, those stocks are also going to be stocks that people want to flood to over the next 1 to 2 years. So I think those 2 stocks I spoke about in that video, phenomenal setups for the next 1 to 2 years. And that, I'll be buying every share in sight of those stocks. Stocks like these 3 are also, in my opinion, a great play. ELF, Wynn Resorts, Celsius. Why stocks like ELF and Celsius? Well, think about this for a moment. Those stocks are more small cap-ish. You might not put them directly in a small cap, but Celsius and ELF, they're such small market caps in the nowadays stock market. In today's stock market, seems like almost every other stock's $50 billion plus market cap. And we got companies that are now $1 trillion, multi-trillion dollars. So companies like ELF and Celsius are like smalls, right? But you got to understand, ELF and Celsius are what? They're super high growth companies. So you got to understand, people always want to be in super high growth companies. Regardless of what's going on out there, if you've got the big growth rates, people want to be in those stocks. And ELF and Celsius are going to have the huge growth rates this year. Or I should say next year, technically. My brain's already on 2026. But in 2026, ELF and Celsius are going to have massive growth rates. And I've spoke about that many times on the channel. You can go back and watch previous videos on why those companies are going to have such insane growth rates. But it doesn't matter what market you are in. If a company really has great growth, people want to be in it. People don't want to be in growth stocks if the growth stock is going through a period where the revenue's flatlining or going down. So for instance, all the growth stocks in the tech category like Meta, Nvidia, those sort of stocks, right? Those sold off massively in 2022. But the reason those stocks sold off so heavily really has a lot more to do with those growth rates of those companies came to a grinding halt. Look at where Meta's revenue growth was at the end of 22 and the beginning of 23. It's hardly anything. Look at Nvidia. Numbers were embarrassing out of Nvidia at the end of 22 and into the beginning of 2023, okay? And so those companies have the growth. People are going to want to continue to flock into those. Wynn Resorts sets up very well. Wynn Resorts, at the end of the day, they cater to what? Oh, by the way, one more point in regards to ELF and Celsius. This matters significantly. Everybody can afford their products, and they would be seen as needs-based products. Cosmetics, beauty-related products, they're seen as needs-based. Energy drinks company, they're seen as needs-based, okay? But Wynn Resorts, a couple factors here for Wynn Resorts that's really positive is interest rates are likely going lower, right? Interest rates go lower, that's good for a company like Wynn that has to take out a lot of debt to finance big projects, right? Additionally, when it comes to a company like Wynn Resorts, they have their big Middle East property they will be opening likely in 2027, okay? That's going to be a huge opportunity. We just don't know how huge of an opportunity this is, but this is probably the biggest opportunity for a company opening a resort anywhere in the world since Marina Bay Sands opened around 15 years ago in Singapore. That was a game changer for Las Vegas Sands. And you could look at Marina Bay Sands numbers in Singapore even nowadays. It's unbelievable how much money that property makes at Las Vegas Sands. This is a sort of opportunity Wynn Resorts has with their property they're going to be opening in the Middle East. I mean, the amount of high net worth individuals in Dubai and Saudi Arabia and that whole region is unbelievable. Plus, you're going to get a lot of high net worth individuals from Europe to go over to that property as well. And the Wynn brand is just so phenomenal there. So just get ready. Just get ready for a pretty exciting time for Wynn Resorts, and you could start to have a lot of hype and excitement coming to Wynn Resorts in 26, being that you get closer and closer to that property opening in 2027. Okay. Now, what about a hedge I considered today, and then I decided against it? And let's talk about hedges in general in case this market, let's call it goes left a little bit. Okay. Here's a deal. There's a stock I was thinking about hedging against today. You know what it is? It's this one. Tesla, Tesla, I consider this one. We know the fundamentals with Tesla are very bad. That's not an opinion. That's a fact, right? Look at their auto sales. Look at how much their energy business growth rates have collapsed. Look at their auto sales around the world. You can look at them basically in every market. It's bad, right? The only thing positive around Tesla, and it's in a hype cycle right now, is people are excited about maybe robots someday, right? And that might be a big thing. Robotaxi. We've seen a lot of things that were supposed to be big for Tesla not being big, right? There's a long list of them. Cybertruck's is one of them. Like everybody and their grandma was supposed to buy a Cybertruck, and then the sales numbers of Cybertruck are just embarrassing, just to be quite frank, right? So Dojo was supposed to be this, like so many, there's a long list of things I'd go through that were supposed to be the big things for Tesla and they never ended up being. So maybe robots are the big thing, but that's like a 2030s thing. Maybe robotaxi is going to be a big thing for Tesla, but in terms of that being meaningful to Tesla's business, if it is ever, that's still several years away in terms of meaningful to the revenues and the profits. So there's really, Tesla has nothing going for it in the short term when it comes to their business model, positive, nothing. But the stocks ran huge because of the hope and excitement of something down the road, and obviously the excitement of the stock market in general. So I considered March 20th, 2026 puts, right? Here's a deal. I looked at 430 strikes, had to pay $65 for them. That's insanely expensive. That means my break even is $365. I need Tesla to go down $365 to break even by March 20th. And keep in mind, if you're buying puts like that, you're really trying to double up your money. So which means I wouldn't really need Tesla to go like 300 or below by March 20th to double up my money. Might happen, but still, like, I'm just not willing to take that sort of risk. It's so expensive. I mean, if those were $35, I feel very different. $25, you got me. I would have bought them today. $65? Come on, man. That's insane. So, I definitely decided to not go with those. And so, no hedge there. I've considered maybe, and by the way, and also in regards to Tesla, like the pump might not be over. Like I've been testing the waters on X, trying to see how strong kind of the retail community is. They seem still really, really strong there. So, there might be some more pump activity that happens in Tesla short term. So I might come in and slay that dragon eventually, but not right now. Not right now, right? Now, another thing I was thinking is SQQQ. SQQQ is basically a 3x leverage against the NASDAQ. Why was I thinking about this? Well, if you look at the public account, I'm extremely invested heavily into companies like Meta, AMD, Palantir. I've taken so many profits in that, but it's still a big position for me. Google, and many other stocks. A lot of NASDAQ stocks. Now, the whole portfolio is very well diversified, but still, you got to look at a lot of big positions in there. They're NASDAQ type stocks. And so I thought, if that NASDAQ turns the other way, like SQQQ would save me a lot of face there on a 3x leverage on the other side, right? But we'll see. We'll see in regards to that. Nothing I want to do right at this moment. I kind of want to see how this market shakes out here. And I do naturally have a little bit of a hedge in the market right now. I have a good amount of cash around. I have $97,000 worth of cash in the public account. I have other cash around. So if this market goes south in the next, few months here, I do have cash ready to go just in case it does. Okay, so that's kind of a natural hedge I have on. Okay, now with all that being said, we got a drama show upcoming here in the market. Stay focused on long term, folks. Stay focused on long term. Remember, you're building a portfolio for the next 5 to 10 years, not the next 5 to 10 days, not the next 5 to 10 weeks, not the next 5 to 10 months. You're building a portfolio that's going to be a great beast portfolio for the next 5 to 10 years, right? Make sure you got more income than expenses. Make sure you know what you're doing in the market, income statements, balance sheets, cash flows. You can focus on what you can control. You cannot control whether the stock market goes up or down 10% over the next 3 months. But you can control what type of companies you invest into. Do you know what those companies actually do? Do you have a great understanding of them, right? Are you getting caught into traps and investing in companies that you don't really know what's going on? Are you gambling money around without looking into income statements, balance sheets, cash flows, without listening to conference calls? Don't do that game, okay? Stay focused on long term. Make sure you know what you're doing, and let's build great portfolios for the next number of years, okay?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are 3 main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management, and you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
Alrighty, next up here, let's talk about some potential hedges I might put on after the rate cuts come. Then we'll get into some easy money stocks and how to avoid dead money stocks, okay? First one of these that is a potential hedge I could do after the rate cuts come and that bullish activity concludes is Coinbase. So Coinbase is actually interesting as a potential hedge. We know crypto's been hot since really the fourth quarter of 2022, right? We know Bitcoin's been on the move, all those sorts of things. We know there's a lot of excitement about the crypto space, for the last bit of time here. But there's a potential that after the rate cuts come, we could see a chilling of the market. And that's opposite of what a lot of people think. A lot of people think, okay, rate cuts come, bullish crypto, bullish everything, Bitcoin, everything like that. There's a potential it maybe goes the other way in regards to that shortly after you get those actual rate cuts, right? And additionally, you got to understand, we're in a very, we're in a great crypto market. I mean, Bitcoin, if you go back to the fourth quarter of 2022, where was Bitcoin then? I want to say Bitcoin was was Bitcoin like 20,000 or maybe even under 20,000 back in 2022? And you look at Bitcoin today, and it's like, oh my gosh, what is it, 5x, 6x, somewhere around there? Maybe 7x? I can't remember exactly where the low was at for Bitcoin. So we've been in a massive expansion cycle. There's been a ton of money to be made with Bitcoin and Ethereum, right? And so, looking at a forward P of 40 right now, I wouldn't want to pay a forward P of 40 plus on a stock when you've already had the massive come up in regards to this asset class over the last few years. And so, I think this is something to consider here. It's very expensive for the stage in the cycle. Now, if Coinbase was at a 40 forward P and you were in down and out times for Bitcoin, if let's say this was 2022, right? Bitcoin's crashed, Ethereum's crashed, no one wants to buy crypto at that particular time, and it was trading at a forward P of 40, then you can make a very strong argument that it's a huge buy. Why? Because you're like, Bitcoin's going to come back, Ethereum's going to come back, crypto's going to come back, it's not dead forever, and you're willing to pay up for that. But when you've been in a massive expansion cycle and so fortunes of money for somebody like Coinbase to make the last few years, trading at those sorts of valuations is actually a little worrisome, okay? Next one up here are these potential hedges is good old Tesla Tesla. There's a potential I could put on a hedge against Tesla come, let's call it October, November, somewhere around there, December, right? You got to understand with Tesla, it's been in a massive hype cycle. And the hype cycle's around robots. The hype cycle's around robo-taxi, right? And even today, the Elon Musk news, Elon Musk bought $1 billion worth of shares, which, by the way, is literally nothing for him. I mean, you know what his net worth is? Buying $1 billion is not much, okay? But there's a lot of hype about all those sorts of things, right? His new pay package, $8.5 trillion market cap. There's crazy hype all over the place with Tesla, right? It's one of the most hyped times I've seen in regards to Tesla, right? Robots, if they ever become meaningful to Tesla's business model, that's not any time in this decade. You're looking at the 2030s for that, okay? And that's if that even plays out. Robo-taxi. in order for that to be meaningful to Tesla's business, you're looking at the 2030s also, right? 2026, they'll probably get in a few more cities and test a little bit more. 2027, a little bit more. 2028, 2029, maybe they get a nationwide launch throughout the United States of America and it starts scaling. But to be meaningful to Tesla's revenues, you're looking at the 2030s for that. 2030s, okay? So that's a while out there, right? Elon buying shares, like that means nothing. Like I said, it's such a small amount of money for him. You got to understand when it comes to Tesla stock, it's a call or put option on the NASDAQ, basically, okay? And to illustrate this point, I pulled up a 5-year chart of Tesla and the QQQ. And what do we find, right? Tesla goes through these bullish runs along with the QQQ many times, right? And you look right here, NASDAQ peaks, Tesla peaks, and then we get that massive drawdown in 2022. NASDAQ got hit, if I recall, the NASDAQ got hit peak to trough here, like 37%, somewhere around there roughly. Tesla got hit, if I recall, peak to trough around 70 to 75%, okay? Then market comes back. Guess what comes back with the market? Tesla, right? Then we get that topping here, toward the beginning of the year, and then we get the April crash, right? Tesla gets hammered, the Qs get hammered, Tesla gets hammered way harder, obviously, than the Qs, right? Then we get this comeback that we've had recently. So Tesla's just moving with the market, and it's a call or put option on the NASDAQ. And here's the thing, as long as the NASDAQ keeps rolling, Tesla rolls. As soon as the Qs can roll over, and by the way, there are time periods when Tesla can do bad even when the Qs are doing good, so that's why Tesla's kind of a little bit extra risky when it comes to that, right? But as soon as the NASDAQ turns, guess what's going to happen to Tesla? Down, down, down all the way to Chinatown, okay? So that's just the bottom line in regards to that. Another stock I'm considering potentially hedging, let's call it in the fall time, is the Hood, Robinhood. Now, here's the thing with Robinhood, right? Obviously the stock's been a beast the past year, up 429%. The turnaround in the financial statements is historic, right? What a turnaround in the income statement in the last few years. What a turnaround in the balance sheet. They've done amazing for themselves. The issue for Robinhood, and I don't think investors are quite ready for this, is they got brutal comps to comp against in 2026. Oh boy, it's going to be nasty. They're going to have to comp against these incredible user numbers, assets under management numbers that they're all posting here in 2025, right? You got to start comping all those numbers in 2026. So the quarterly reports they're going to put out in 2026 are going to be, to show major growth is going to be difficult. Very difficult for the Hood, in my opinion. You got to understand from the fourth quarter of 2024 through the third quarter of this year, 2025, we've had the return of the retail trader investor, okay? The return of the retail trader investor basically is just saying, average Joe, mom and pop, right? Heck, I'm a retail investor technically, right? I've been doing it 17 years, but still I would be categorized as a retail investor because I don't invest other people's money. A professional is you get paid to invest other people's money, right? So even somebody like myself that's been in the game 17 years, I'm still a retail investor, okay? And there's a lot of retail traders and investors that got in the market after, Trump got elected, obviously, and it's just been like a kind of a big flush. People feeling bullish, like, stock market's going to do great, the economy's going to do great, all those sorts of things, right? Which, we'll see what happens in regards to all that, but it is what has happened so far as a lot of retail investors, traders getting back in the market. That starts to slow back to, in my opinion, a very normal pace starting in 2026. So there's huge momentum of just a massive influx of retail traders and investors. I think that really comes to a grinding halt in 26. And then you get back to normal growth, which there should always be some new retail traders or investors getting in the market every year, regardless, right? But in terms of the massive influx, that goes away, in my opinion, in 2026. Now, if you look at margin, we got major margin problems here, okay? So this is margin over the past year, essentially, right? We had a big expansion in regards to margin debt from about $797 billion to $937 billion. Then we had the April downfall for the market, right? And margin debt fell to about $850 billion. And now we've had a huge, epic expansion in margin debt from $850 billion to $1.06 trillion of margin debt. That's a massive expansion here, right? And so my guess is this number will likely top sometime very soon here, and then we'll go down. And why is margin debt going up so much? Well, people are feeling bullish around the market with rate cuts coming, all those sorts of things, right? And so you got to understand when that margin debt gets hammered next time, like I think it's going to hurt Robinhood pretty immensely in regards to that. Doesn't mean Robinhood's going BK or the no. But you got to understand, when you're priced the way Robinhood's priced, like could your stock go from $115, $120 or whatever down to $60? Like sure. That's about 50% downfall. So that's the part you got to understand. And even at $60, Robinhood would still be up massively from where it was just at the start of we can say just back in 2024 when it comes to Hood, right? Remember, Hood was $20 roughly a year ago. So this stock could go from 115, 120 down to 60 and fall 50%, and it would still be up massively. You see where we're going here? No, additionally, in regards to Robinhood, and this is a no bueno situation here, is Robinhood's forward P 66. Listen, man, we're in a booming bull market. The retail trader investor has gotten massively involved in this market. We know that. And you're trading at a 66 forward P. It's not the time. It's not the time to be trading at a 66 forward P. Once again, if you're in a stock market crash and Robinhood's trading at a 60 forward P, there's a strong argument to be made that it might be worth buying, because you're saying, okay, the market won't be crashed forever, and eventually assets under management will start going up, the stock market will start going up, retail investors and traders will start returning to the market, and Robinhood's numbers will get a lot better. From here, after 2025, it gets tough to make a case that Robinhood's numbers are going to be booming in 26, 27. Very, very tough to make that case, right? No, I'm very bullish. Let me be very clear about my stance on kind of the retail investor, at least. I'm very bullish on the retail investors, over the long term. So let's say over the next 2 to 10 years, extremely bullish. I think it's been a phenomenal time to be a retail investor. I think it continues to be. The access to get educated on stocks, right? I think even the ability to use AI to get data even faster. I think things like even being able to do something like we do on 1000xstocks.com, where you can listen to a conference call at 2x speed. Like that wasn't even available a few years ago, right? And now we have a feature on 1000x where you can listen to a conference call at 2x speed, or if you want 1.5x. So you can listen to more conference calls, get more information, more data, do your study faster. Tools like 1000x where you can compare all these features. Like this is stuff you didn't have access to in past years. Like this is insane, right? And now you have access to it. To be able to use products like ChatGPT and others to do research. Even something like we launched recently in regards to our conference calls, which is AI, which was basically where AI will go ahead and pull out the most important chunks from that conference call and feed it to you. We do that on 1000x. Like all that stuff is like insanely valuable. So, I'm not necessarily the most bullish on retail maybe the next 12 months, because I think there's a good chance we have a strong pull down, at some point in this next 12 months. And I think a lot of retail that maybe has gotten a little too confident in the market without putting in the work is going to come back to bite them big. But the people that will last are the people that are doing this game right, the ones that actually know how to understand income statements, balance sheets, cash flows, that think in a practical matter in regards to the market, that know how to run valuations on companies, right? That understand forward Ps and 2-year forward Ps and what's a good price to pay for a stock versus a bad price. Those people will be just fine. They'll make it through. They'll buy the whole dip. Whether we have a small correction, medium correction, large correction, or a crash, it doesn't matter what happens. Those folks will be just fine, right? They'll buy the dip. They'll get incredible deals on incredible companies, and that will be fine. But the people that don't know what they're doing, they'll get flushed out of the market, and it'll end very badly for them. And they'll end up of just wasting money and time by, doing what they were doing essentially, which is not putting in the work, not understanding the stuff on a high level. And I could teach you it all. Like, you want to learn, you not want to learn. It's up to you, man. Make your own call out there, right? No, additionally, the consumer sentiment's bad. Like, this is the newest numbers here. U.S. consumer sentiment drops to the lowest point since May. Consumer sentiment continued to slide in September, falling to its lowest point since May, as tariffs seep into product prices and Americans start to spend more cautiously. University of Michigan preliminary September sentiment index released Friday declined 4.8% to 55.4%. Consumers continue to note multiple vulnerabilities in the economy, with rising risks to business conditions, labor market, and inflation. Likewise, consumers perceive risks to their pocketbooks as well. This is going to eventually affect the top of the market, right? Which has been untouched by all this so far. I think there's a decent probability that it starts to touch the top of the market in 26, right? Or maybe even at the end of this year, right? Once we kind of get through the whole bullish optimism around rate cuts. People got to understand rate cuts could be coming for the bad reason. What is the bad reason for rate cuts come for? It's that you got major problems with the economy. That could happen. I don't think people have factored that in yet. People are they're just in the kind of the optimistic mode in regards to rate cuts. And they're kind of like, woo, rate cuts, let's go, baby. Like, stocks at all-time highs, we're getting rate cuts, we're going higher and higher. And that might be true very initially, but just understand the Fed could be starting a rate cut cycle for the wrong reasons. And the wrong reasons is the economy gets worse and worse and worse. So that's just something to factor in there. And I hope that's not the situation. I want the economy to strengthen in 26 and beyond. But, you have to acknowledge that it could go the other way here, right? And that's where if you're in the wrong companies and this economy goes like really, really south, ooh, boy, your portfolio is going to get absolutely sent to the slaughterhouse in that sort of situation, right? And, some companies won't come back from that. No, when it comes to consumer sentiment, you got to understand this, right? I posted this inside my private stock group, and I said, this is not a pro-Trump message. This is not an anti-Trump message. This is just being like having an observation, right? When Trump came into office the first time, consumer sentiment was in a pretty good place. It wasn't necessarily great, but it was pretty good. And then, once Trump got elected and everything, like the consumer sentiment was unbelievable, right? For that next 3 years, basically, until Rona came, and then consumer sentiment obviously crashed after that. But it's a very different dynamic we had with Trump 1.0 than Trump 2.0. Because Trump 2.0, he took over consumer sentiment that already wasn't good, right? It was already bad considering, where consumer sentiment is when Trump came in the first time. But the issue is, the consumer sentiment hasn't really come back, right? It's just been kind of getting worse and worse and worse. It's come back a little bit since that April drama, the tariff drama, right? Liberation Day. But at the end of the day, we're headed right back down. And so it's a very different dynamic we have in Trump 2.0 when it comes to consumer sentiment and how the average person's feeling. I think I think there's a lot of different reasons Trump got elected, but I think, one of the reasons I knew Trump was going to win the election without even a question was I think there was a feeling a lot of Americans had that they felt like the economy was good under Trump. They felt like their life was getting better financially under Trump, right? And they still had that feeling. And so, during all those, huge inflation numbers under Biden, people kind of felt like, I don't feel better. I feel worse about my financials. And so they, thought, okay, let's elect Trump again. He's going to get things all in the right direction here. Consumer sentiment's going to boom again, and we're all going to get back to feeling great again. Well, we're going to have to see. And hopefully that's the situation. But, as of right now, I could say, it's not looking great, right? If anything, it's looking more troubling. And so, we have a different dynamic than certainly we had under Trump 1.0. And that's, and this is some of the risk I spoke about, after when the Trump inauguration happened. I did a full-scale video on why, this Trump presidency was going to be dramatically different than the first. A lot of people thought, this is going to be the first one over again. I'm like, no. It's a lot of different things and a lot of different dynamics here that you guys got to be aware of, so we'll see how it all plays out. But that's certainly, something that's worth looking at and paying attention to, okay?